Good afternoon, everybody. Thank you so much for joining me here for the AMA. I have a lot of stuff planned to talk about today. We want to talk about markets. We want to talk about stocks. I want to talk about perspective of this bull market and what it can do and what are some historical parallels. This is going to be a really deep dive. Actually, it's to be very representative of what we usually have on our weekly calls. And we're really going to get into the weeds of it all and look forward to some really great Q&A session at the end. Just before we do, a regular disclaimer: it's not financial advice. It's purely educationary. It's not a solicitation to buy or sell any equity security. For personal financial advice, please consult a financial advisor. So I thank you all for joining me. I know it's late afternoon for many, but there's people from all over the world. So let's just get to markets and we can discuss a little bit about everything. Before we do, I tend to forget about this. And then after Sinea, who helps me run Crucial Insights, always gets upset at me. But we have a promo going on where usually on a monthly basis, these are $159 and $229. If you'd like to take advantage as a result of signing up for this AMA, this will be only $99. So you can get that at a reduced price to get 2 months viewing. And instead of $229 for 2 months, it will be only $149 for 2 months. So 2 months of a lot of content for, I think, a fairly reasonable price. And also for those who are interested in joining us, this is the end of kind of the early bird for our conference coming up this October 17, 18, 19. We're going to have it in Fort Lauderdale. We'll have email links going out as well if you're interested. I'll be speaking for a large part of the conference. We're also going to have John Pokoroba, who's running the conference along with me. And I'm sure most of you know Mike Webster, who's a senior market strategist at IBIT, as well as Jason Shapiro, who's hedge fund manager and market wizard and all the rest. So going to be, if you're looking for a conference to network with great people who are dedicated and learning a lot and having a really good time, I think this is the place to be for this fall. So there's a nice early bird that'll wrap up this fall with some nice different pricing depending on what is interesting to you. So now that all that is out of the way, let's get to this market. I want to talk about a bunch of different parallels. I wanted to. It was interesting. We've been having these AMAs once a quarter. So we had one beginning of the year in January, which was interesting timing coming out of what was a strong end of last year. We had one in March, so right ahead of all the tariff debacle and all the rest. And we had one in June coming out of the tariff drops and the start of this bull market. So for those who, for those of you where this is the fourth one that you kind of come along with here, you can see that we've had a very diligent process throughout this market year. We came into the year pretty aggressively long, focused on AI names. We had hedged some of those, thankfully ahead of all of the DeepSeek and AI panic. So that wasn't too harmful for us. And by the time March rolled around, and the reason we had done the AMA in March, let me actually bring up the chart so we can visualize what we're talking about. By the time we kind of got into March, at that point there, one of my favorite tools for trend is looking at the number of stocks making 52-week highs versus 52-week lows. That really showed a lot of weakness in the market. So we were in full cash, thankfully. And by the time June rolled around, we had already positioned very strongly coming off of the bottom and focused on a lot of leaders. We'll take a look at that later. But just kind of going through it even in real time, because everyone's always a maverick when you're using old charts. When you're using the real-time charts, that's where kind of the difficulty comes in. So I think this is a great year to kind of just show how you can navigate markets in a way that's never predicting. No one ever knows what's going to come next. It's just you have to have a good set of tools, confidence in how to use them, an understanding of how to use them, and a simplified process, which is what's really helped us along the way. So now, as we've had this big rally off the bottom, I think this is a really important time to have a follow-up call. And this is why I want to kind of book it now, because interestingly enough, if I just get to, apologies, let me just get to my profile here on X because I posted it recently, just this past weekend. If we take a look at the American Association of Individual Investors, if you look at the sentiment survey, it's interesting, despite the markets having had a big run up, there's still quite a bit of pessimism. And that's really strange. It's really strange for markets to still have people who are negative with the market making all-time highs. It's kind of, people are arguing we've gone so far, we have to have a pullback. There's a lot of froth in the market, but that's not represented in the sentiment. Now, some people can say the argument is all people are positioned anyways, so it doesn't matter what they say, it's how they're positioned. I don't think that's true. In my career, I started trading professionally in 2008. I started trading as a teenager in 2003, so it's been a while I've been kind of doing this. People are never negative at a major market top. What I think is driving this type of dynamic and why it's important to kind of have a good understanding of the context in which to look at these different tools and indicators. If we take a look real quick at the QQQ, let's bring this up really quickly and move this box out of the way. Actually, rather, let me bring the mid cap stocks. QQQs are a little bit of bias to the upside because of AI. If we take a look at what mid caps have done, this has been a hard few years. If you take a look at this after we had this run up here into the end of 2018, take a look at the number of sudden and sizable drops. You had a bear market settling in 2018. Then there was COVID. Then after a nice big bull market, it looked like, the money printing will never end. Big bear market that came out there. Then we had very choppy and difficult markets. Then finally, as markets start to kind of get to all-time highs, we get all of the tariff debacle. People have been very much trained by the market to expect the rug to always be pulled out from underneath them. And it's interesting because it's kind of the opposite of what I saw earlier in my career. People had come from the 90s. And so, obviously, I started trading in 03, 04. But most people kind of viewed that as a really nasty, bad bear market, one that was kind of deserved because the .com froth was so high, but they were still kind of accustomed to the really big bull markets of the 1990s, and there were many of them. So I think what's partly driving this sentiment here is that people have just been kind of trained by what has been a pretty nasty market over the past few years to just whenever there's something that's good that comes around, then it's time to expect something that's a little bit nastier. But I think we're in a kind of a unique place right now. Like if we have to look at like a historical parallel, I think we're kind of basically in the 1995 era. Let's just go back to 95 for a second. And if you take a look at 1995, this is the NASDAQ. 1995, interestingly, was actually the best year of the 1990s for the S&P 500. The NASDAQ only did better in 99 than 1995, but for the S&P 500, 1995 was actually the best year. Look at the intensity of this move up. But like I always like to kind of argue, when people study charts, there's a lot of biases that kind of come through. And it actually makes it very difficult to use in real time because when you look at a chart and you're looking at all of this, these little drops don't look like anything. This looks like it was very easy to sit through. But if you kind of rewind the charts and you look at it in real time, and you saw this very dramatic move off the bottom here in December of 94, straight up to the highs, March of 95. You had rallies in December, January, February, March. You're almost stepping into April. Would you expect, if you're just looking at the stock chart, and saying, well, yeah, sure, this is going to extend now. We're just kicking off a massive nonstop resilient bull market. You wouldn't expect that. As soon as things would turn around, people would expect, we're about to kind of move lower. Then, this is the bad, nasty correction we should be expecting. Now we're going to break lower. I told you this is too late to buy the market. And this market just kind of kept surprising and surprising. I always try and argue with people, not argue, but kind of my perspective when studying charts is don't just look at the chart patterns. Stock charts are an important tool, but they're only reflect demand and supply. Stock charts don't cause the market moves. They're just a reflection of how institutions are moving around the marketplace. So when you look back at just the whole picture, it really doesn't reflect what it felt like in real time. So, I'm going to get into why I think 1995 is a good parallel. But it's interesting now with so many people so negative, we have just taken out bear market, the bear market highs basically, just gotten above. And after that strong rally, we had a first 3-day reversal. That is very similar, just in terms of price action, to what we're seeing right here. We took out the old highs and we had a nasty 3-day reversal. And it's not just you. It's not just some people. Like the majority of people, as we saw, like by sentiment, don't think this market is going to continue higher because it feels like it's gone too far too fast. But it's interesting. If you look back, 1995 is not the only example where you can see these really strong, dramatic bull markets. First of all, looking at the bottom, just to kind of put some numbers to context, you look at where things actually really start to get going. We're 82 trading sessions into this uptrend. Even if we ignore the COVID bull market, which was, a very good bull market, but driven by abnormal times. If you take a look at some other strong markets that always come out of these choppy, bearish periods, these are some really dramatic advances. This is not even the 1990s. This is 2016 to 2017. That's 400 trading sessions of almost relentless buying to the upside. And you'll see that in many, if you look at 2013, again, when did this very strong continued uptrend come? It came after several years of very difficult markets. And then finally, once that subsided, you had basically 330 trading sessions, so a year and a half of almost relentless upside. We can go back in time. You can look at the 2009 bull market. If you think this bull market is hated, my first trading day of my professional career was January, the first trading day of 2008. So I started right here, probably worst timing possible. I'll tell you, there wasn't one person who was optimistic about the market in March of 09. It was widespread panic. I worked at one of the big financial institutions, and even kind of management was wondering, like, are we going to survive this type of environment? And then we turn around, we have 284 days of resilient markets. So why the optimism? I'm not an optimist. I always try and lean to the side of optimism. There's so much negativity out there. Markets generally trend higher. Human beings generally try and make progress. Productivity generally pushes things higher. But I think there's a really important reason why we need to be very optimistic in this market environment right now. This is kind of framing the whole way I'm going about my process, the stock selection. The way I like to do things is kind of think big picture and then zero in and find the individual stocks and the themes that do well. If you look back to 1995, again, and you want to study that, let's look at 95 again real quick. Coming out of this corrective period here, it was really interesting. What caused this market correction? If you take a look at the federal funds rate, this is the interest rate that the Federal Reserve controls. This is what everybody always talks about. And you can see back then in 94, 95, inflation was still a big worry. They had just conquered it, 10, 12 years earlier in the early 80s. And so the chairman at that time, Alan Greenspan, he noticed that the unemployment rate had come down pretty aggressively and the labor market was getting, like they say, tight. There's a lot of people looking for work. That usually pushes up inflation through, people being able to get higher wages. So no inflation had showed up yet, but he decided to kind of bring rates from 3% to 6% because he was worried that inflation was going to come about. So it kind of, there's always, obviously tariffs are a different situation, but at the same time, worries about inflation-driven tariffs haven't showed up yet, and it's caused the Fed to keep rates higher for longer. We'll see what ultimately comes out. But there's an interesting parallel, whereas the Fed ended up cutting rates when the market was already all-time highs. And that really ushered in this next big dramatic move higher. At the same time, you had come from what was a long period of difficult markets. I mean, the 90s are remembered for being a good time, but from October of 93 until April of 95, markets went nowhere. That's a long time to go absolutely nowhere. That's a hard environment, similar to kind of what we've gone through for basically all stocks outside of AI, essentially. And so you came out of a difficult period of time. You had the Fed trying to get ahead of inflation and hiking rates, which is hard on markets to kind of get ahead. And at the same time, under these pressures, was a technological revolution that changed the way we live, work, and play. And so if you look at those kind of similar parallels today, you can see, obviously this interest rate hike was needed because there was major inflation. But now at this point here, even the Federal Reserve, if you listen to Chairman Powell, says, rates are restrictive. If it wasn't for the tariffs concern, they would be cutting rates. So they want to see how that plays out. But essentially, and ironically, if that doesn't kind of come through in terms of tariff inflation, if more deals are struck or maybe, suppliers eat a bigger part of the tariff costs, we're going to end up in a situation right now, if you look at what the markets are pricing, where again, the Federal Reserve is going to be cutting rates with stocks at all-time highs in the midst of a technological revolution. Now, one thing I want to point out as well, because there's different schools of thought. Some people will say, hey, if you just look at the federal funds rate, usually that's a bad thing for markets when rates go down. If you look at 2007, 2008, people say, well, when the Fed cut rates, the market fell really badly. If you started buying when the Fed started cutting rates, I mean, you were sucked down by the entire bear market of the financial crisis. And if you look at the government yields, this is the government 10-year, same thing. When rates fell here, it's like, wow, the market. So why that disconnect? Like, is it good for the markets or is it bad for the markets if rates are falling? Well, the very important difference is the Fed late in fixing a problem, or is the Fed just taking off kind of the restraints on the economy because they feel that inflation is now under control. A good way I like to measure that myself is if you look at the interest rates on high yield bonds, junk bonds, lower quality companies, they're really cool to study because they're bonds, just like a government bond. But unlike a government bond, you don't know if you're going to get your money back. These are lower quality companies. So these companies act like a bond, but they also have an element of risk to them. So when you look at this environment here, the market wasn't falling because interest rates were going up and that was choking out the economy. The market was falling because risk was going up. So if you take a look at the interest rate on high yield bonds, even though government interest rates were falling, high yield bonds, interest rates were skyrocketing. And so if you take a look at some other examples as well, let's just go back in time here a little bit. Let's say COVID, similar situation. The Fed cut rates very quickly early on here in March, and you can see the US government yields were falling. So if you just looked at interest rates, you'd say, wow, this is the all clear signal. But that's not what the market was saying. The market was saying, guys, I know rates are falling, but the world's shutting down. There's significant risk beyond just interest rates. The market lives on both risk and interest rates. That's like the core, the two things that will drive markets is risk and interest rates. So if we take a look at the current environment, what environment are we in? Are we in the 1990s where the Fed has been just holding the market back, for good reason, making sure inflation doesn't get out of control, where when they kind of take off that restraint, the economy bolts higher? Or are we in a 2007 scenario where the Fed's late to cut rates and the economy's imploding? Well, if you take a look at what the interest rate is on the same junk bonds, they're still pushing lower. They're actually pushing lower more quickly than government yields, which is pretty odd. That shows quite a bit of market confidence. So this really points to actually a very strong economy under the hood. So if we do get the Fed to start cutting rates, that should really kind of cause the market to spring to life and go into a much broader and bigger bull market. So again, if we take a look at mid caps, mid caps have gone nowhere for a long period of time. We're still in the same place April 2024. Just recently, where were we here? On July 29th, we weren't far from the 2021 high. Same with small cap companies. These are still below their 2021 high. And that makes sense because these companies are lower quality and interest rates make a big difference to them. Apple, Microsoft, they're immune to small changes in interest rates. They live in their own world. They can kind of call the shots when they're borrowing, and they have a much bigger borrowing capacity and cash flow. They're not as hurt. But the general economy stocks really depend to a much larger extent on falling interest rates. So when looking at this economy and we're looking at the stock market, yes, it's been a good rally off of the bottoms, but we've still been having to deal with the Fed not wanting to cut rates. We had a small cut last year, and then we went to the tariff debacle. But if we start to get rate cuts now, you may finally see this really big, broad opportunity in a big bull market. So now, what does that mean? Like right now, we're just setting the stage. We're looking at where the market is, what are the core pillars of the market, and why we need to be optimistic. But if we take a step back, again, a little bit further, that just sets the stage for the environment. I like to not think just about bull or bear market. I like to think of what kind of environment. Are we an environment that's good for stocks? Are we an environment that's bad, tough for stocks, or hard to trade in? If you get falling rate cuts and you get an AI boom and momentum, that's a phenomenal market for stocks. And again, people unfortunately have been trained to expect the worst. But if you go back to the 90s and you look at something like a Cisco, I know those who have seen this chart before are going to know what I'm pointing to, and they're going to say maybe it's a bit of an exaggeration. But if you go back to the dot-com peak, it's a good thing we have these charts. It would almost be kind of hard to believe what's possible. But from this early IPO period, this stock went up 86,000% over a 10-year period. This is a log chart. If you take off the log chart and you look at just a regular scale, look at what this did. It's almost, I think, $10,000 would have turned into millions, over almost $9 million. Imagine if you had $100,000 investment. Now, my personal goal, to be honest, is not to really sit in something for 10 years. That's not my process. But there were tremendous opportunities along the way where you could have captured all of these significant uptrends along the way to kind of put your money to work and still capture really, really great returns. If you can compound different environment. If you look at that 1995 period here, over just a few months' time, Cisco had a 175% advance. you can run that through multiple different stocks, even without being on margin, without crazy leverage and all the kind of stuff you'll see in a lot of different places. You can have really life-changing returns over these 4 or 5 month different periods. And you can compound that over time and really make some phenomenal returns. Now, what is also interesting about 1995 as an example, I recently put a YouTube video. Let me just see if I could find that really quickly, just to kind of, if people want to kind of dive into it a little bit more, but I'll give my thoughts real quick. Here we go. So if you head over to YouTube, you can see this one here, the AI stock market playbook, lessons from .com winners. I recommend you take a look at that. I put a lot of work into that one. But if you take a look at the 90s followed a really interesting progression, which I think we're following today the same way. What is Cisco? Cisco was one of the first big winners that kind of came out of this period. Cisco, no one uses Cisco. I mean, like by that, I mean, there's no consumer that's going out to buy a Cisco product. When people got involved with the internet, they were using Yahoo, the Yahoo portal. They were going to America Online. They go to Amazon.com to buy something. Cisco was the backdrop. They were the routers. They were the networking gear. They were the backbone. They were the infrastructure. And so for these technological waves, you almost always start with the infrastructure. And then once that's in place, you move on to the use cases. And so we're getting that very similar situation right now. If you take a look at Nvidia, for example, which has been one of the leaders of this cycle, that's for sure. You know, this first mover advantage here in Nvidia, this is infrastructure. If we look at all of the really kind of great AI stocks, we can look at GEV, GE Vernova. This is electricity. This is infrastructure. If you look at Palantir, Palantir is very much like what Microsoft was. It's like the operating system for AI for these large enterprises. That's infrastructure. No one's buying Palantir products, like, I mean, as consumers. So we're still very much, if you look at the 1990s and you look at that whole period of time, when people start to go in droves into the internet, it's when the groundwork was laid, the networking gear, the routers, all that was set up, the cabling, the telephony, everything was, you know, the internet service providers were able to get the technology to onboard all of these people. That was really done primarily the first 3, 4, 5 years when the visionaries could say, wow, if we can get scale, this will transform the world. And once that was in place, then we moved on to the actual use cases, the different products, again, like Yahoo and all the rest. And again, if you take a look at Amazon, when did Amazon, you know, come to fruition and get going? This was 1997. This is when this kind of came out and had its tremendous moves. That was many years after the internet bull market already began. There's so many other stocks we can look at. I don't want to spend too much time on that today because I want to get to the current market. But if you take a look at all of the stocks that we're looking at right now, GEV, NBIS, which is they provide cloud computing for AI, for people who want to use AI data centers and don't want to build their own. If you look at AMD, where they're trying to compete with Nvidia, where are my notes here? Let me just see. Yeah, anyway, there's so many of the AI stocks are not really an AI product. And again, another good example of someone who used the internet late in the 2000s, had a tremendous advance, was Schwab. You can see they kind of offered discount brokerage, online brokerage, and we went from 7 to 52 very, very quickly. So if we look at that progression and we look at where we are in things, the first, you know, browsers, the first portals, they came out in 1995, that era. Everything before that was infrastructure. We're still at a stage here where everything we're building is infrastructure, and we're starting to look at the use cases. We're starting to see the potential of self-driving vehicles. That's a use case for AI. We're starting to get like excited about, you know, can we have diagnostics for AI? Can a computer do a better job of spotting? I hope so. Hopefully, you know, everyone worries about the Terminator taking over. Let's at least get some of the good stuff, like, you know, better healthcare, ideally. But, you know, someone like a Tempest, if they can succeed at what they want to do, that would be phenomenal. Instead of having doctors looking at charts, we can have AI interpret scans and graphs and all of the rest. These are the use cases that are just starting to try to come to market. So again, if you try and put a date to how we're following that same kind of transformative period of the .com, because that's the best example, the best kind of playbook we have in existence, and it's fairly recent, that we can use to kind of see how should things progress from here. Well, that really puts us at 1995. And that's really exciting because, again, if you go back to 1995, even just looking at the NASDAQ, that's when all of the exciting period really took place. I mean, if you kind of look at 1990, let's not cherry pick the bottom. If we look at just before, and we go to 1995, that was 67% over 240 weeks. And if you look at the next stage when the exciting things happened, that was 558% over a similar period of time. So that's the halfway mark in terms of time, but it was still very early in terms of what the scale would ultimately become. So I think rather than kind of being concerned about there always being another shoe to drop, what's bad that's going to happen? Why is the market going to break? This is going to happen because of this result. If you take a step back and you look at how transformative the AI bull market is, and you look at what is the exact same transition of everyone putting tons of money into infrastructure for these products, we're on the cusp, I think, of a boom like no one in this generation has seen. Even myself, I'm 39 going on 40. I wasn't trading the 90s. I remember the wild stuff, but hearing about it as a kid. My dad, was into stocks and all the rest, but like that kind of era of incredible opportunity is just kind of starting to kick off right now. And so if you kind of look at so once we have all of this process and we have this kind of viewpoint, how do you time this? Like that's where the importance comes in, because you can have some really interesting ideas. Upstart was an interesting idea. This is actually an AI use case. They're trying to automate loans, and this went up to $400 a share in 2021. And if you just kind of said, wow, this is like the next great thing, well, from 400, you fell to, what is that, 12, 10? Basically, you lost almost all of your money. And even to this day, you're still only at $65. You still need a timing element. The thing with innovation is it always looks easy in hindsight. It's always easy to see the winners in hindsight. In real time, competition's hard. If you look at even the smartphone market, let's just kind of zoom out here a little bit. Let me put a weekly chart. If you look at BlackBerry, which was the smartphone king, if you saw this chart, and this is 2008, and they're still making record revenue, would you think in just a few years' time they are going to be totally obliterated by this? Just this, the iPhone, which is interesting. It's different. It's got a screen, but hey, BlackBerry was known for being secure. Everyone loved its keyboard. They were the winner. And after the iPhone was released, this stock still tripled. So I say, hey, maybe we have multiple winners. But at the end of the day, it wasn't multiple winners, and the stock fell 99% and never ever recovered. So you have to have a playbook in place. The beautiful thing is, I think the opportunities are going to be so incredible that you don't have to catch all of these trades, all of these setups. It's impossible. Anyone who says you can be perfect in the market, they're lying to you. The reality is you have to manage your risk the best you can. And when you're right, you really want to be able to kind of benefit and capture those leaders. These leaders concept, I don't know how many here, I think most are familiar, but so much of what I do is very much based on William O'Neill. There's this phenomenal book, How to Make Money in Stocks. And he really laid the groundwork for kind of growth investing. So my background, I was a market maker for many years. I trade my own account. I worked for the bank and ran the bank's money for many years. Had a great time. It was a lot of fun. But my passion was always growth. I just love the idea, like the treasure hunt of looking for these phenomenal companies and be able to really scale up and grow an account at scale with all these opportunities. And what Bill O'Neill did, not only did he give us a lot of like the fundamental traits to look for and all the rest, he really gave us the concept of the leader. What is a leader? If you're going to be looking for these phenomenal opportunities, these things like Cisco and all that, or Nvidia, that is the concept of the leader. In each cycle, there are key stocks which will vastly outperform everything else. Like, why are the triple Qs doing so much better than Russell 2000 small caps or mid? Because Nvidia is one of the bigger companies, and it was the leader of this cycle, and it put in tremendous returns. If you could have bought a lot of stocks at the bottom of the bear market in 2023, very few had a tenfold move like Nvidia did. Same for this current cycle. Yeah, things came off the bottom, but stocks like Robinhood have had tremendous advances. Stocks like GEV have pushed to way higher highs. Stocks like Palantir had dramatic advances. You need the leaders of each cycle. And so the way I've kind of taken the teachings over O'Neill, and with time kind of, it's a variation, but very much on the core of what he built, of course. My definition of a leader is you need to find stocks in a cycle that are on theme, And then when the market rallies, they go up. They go up more than the market. That makes them a leader. But also critically, they have to come down less than the market when the market pauses. That's the strength of a leader. That's what shows true buying pressure. Because if you just look at stocks that go up the most, the problem with that is any kind of volatile speculative stock can have a really fast advance. And then when the market pauses, it just kind of crashes and comes down to earth. It's not very helpful. You really want to, if you want to have something like Cisco, which made Cisco go up 80,000+%, is that it consistently outperformed the market on uptrends and downtrends. That's really where the strength came in. So if we look at what we expect from the 90s, right now this is still the infrastructure stage. And even though 95 we began to look at use cases, there was still more infrastructure stocks that came out with time. But I think we're really at the cusp of trying to switch over to these use case companies. And all this means that you really need to have a hard focus on the stocks that are outperforming the market, both on the way up and on the way down. And you need to build structured portfolios around that. So if we take a look right now at what we've been doing, so this is a good time because it's a few months since our last AMA. With Caruso, we run two portfolios. Some members say like, Matt, I invest in a tax sheltered account. I can't use options or I can't use margin. Some people say, hey, Matt, I want to get as aggressive as I can. So one account will use margin, one account and options. The other account will be just stock and no margin. So people can kind of follow and learn with the path that they want. And so this is kind of like the portfolio we've built up. We have positions in IBIT, which are up 20+%. We have positions in GEV, which are up 27 and 61%. We have positions in Hood. This average cost is this is a bit of an odd average cost. We sold some into strength. That's more of our break even than an average cost, but we started buying this around $45. NBIS, again, we bought these around 41. AMD, our cost base is 127, 134. So this, we also have Rubrik, Ethereum, RKT, SOFI, and we just started a position in Tesla. And we just last week we closed our gain on Palantir for a 90% gain. So it's been a really good rally up off the bottoms. And that's not to say that we don't have losses. We will take many small little losses where and when we have to. The aim is to be able to identify the key leaders and then hold on to them. Now, you'll notice that a lot of these were put on just when we had that last call. You can see the initial buy dates, which were in May and June and all of the rest. Some were in July as well, and recently a few more in August. And the key is really to identify those winners on the way up. But one thing I'm proud of that went well this year, and a lot was just driven by our process, is that even at the worst of the drop in April with the bear market, we're not a buy and hold type of process here. I don't want to sit through bear markets. That's not part of my process. That's where we started our conversation today. At the worst, this like tracking portfolio, which is hypothetical. This is a learning tool, but I run it like a real portfolio, but it's hypothetical. At its worst in April was down 3% on the year. And so now if we kind of take a look at where things are going real quick, just as an overview of what we can do. And this is run more on the conservative side of things, but year to date, it's up about almost 24%. It was up recently just about 25, 26. And at the worst, you can see even in April, at the worst of it, it was down, where is this here? Here, maybe 3% at the depths of April 17th. And we were able to turn that around and get it to positive and keep growing it all through this time. So the aim is to really be able to manage risk in the bad markets, get exposure to great stocks on the way up. And now, even through all these kind of shakes and all the rest that we've had some rough days, the key is to build profitable positions and kind of build into those. So no use kind of just looking at, hey, those are great positions. Where does that leave us now? The reason I wanted to talk today specifically is if we take a look at how stocks rally, we looked at, how a bull market should probably run its course, but how do stocks run their course? Well, we have Palantir up, and this is where we started. We had Palantir this year. Like I said, we had that 90% gain. But we also had Palantir last year. We bought it around 27 or 28 in September, and we sold it, I think it was at 78 or something here in December. That was a really good trade even last year, and we re-entered here. If you look at most leading stocks, and this again applies to that concept of the leader, the tools you use need to be for the job that you're trying to accomplish. I think one problem people have with technical analysis or fundamental analysis is they try and use a tool set for the wrong types of stocks. The way I would trade Costco, or the way I would trade a large, let's say Pfizer, or a large pharmaceutical company, is not the way I would trade growth companies. These companies have a certain style, a certain structure, a certain way of acting. And when these are showing leadership action, they break out of a base. Usually the first touch of a 10-week moving average, this is the same as the 50-day, but it's a 10-week moving average. Usually the first pullback after that breakout is a great time to buy the stock. And that's how we initiated last September of 2024. If we look at that, let me just look at some other examples to kind of show you as well. GEV has been a great winner for us this year, but we also had a great run last year. We started buying this in August of last year, and we sold this in February of this year. But you can see after it broke out of its base, the first touch of that 10-week moving average, that first pullback, it's usually a very high probability setup. If we take a look at Hood, which has been a great winner for this year, but we didn't capture this last year, unfortunately, but we had it this year. But again, as we came out of this basing structure, the first pullback to that 10-week average, in this case, even the second and the third, but especially the first, though, is usually a great time to build a position in the stock. If you go back a little bit further, and let's say we take a look at VRT, which was a great winner in 2023, one of the first big winners along with Nvidia. It's nice to look at something besides Nvidia. Again, when you came out of this first basing structure, that very first touch of that 10-week average was a great buying opportunity. And the irony is, this is a great example to have up here. Even, sometimes when a stock is very strong, it can give the sense of like, oh, this is just so extended. How could this touch of the 10-week average, be of any use? It's got to pull back more than that. The irony of the market, we're kind of trained in life to look for discounts, look for opportunities. The market's not about discount or opportunity. It's really about outright demand and supply. If there is so much incredible demand, it's because there's something tremendous going on. Like people buying this consistently week after week weren't thinking about $29 a share. They were thinking that this could be $100+ a share. And so this relentless strength is a sign that you actually should be more aggressive at buying the stock rather than less aggressive. But again, this applies to a specific type of company. This doesn't apply to speculative companies. Those can have very fast moves and then just wash away. This doesn't apply to a slower moving stock that finally has some strength that can just kind of pull right back down. This is really specifically focused for those stocks that are the leading stocks of each market cycle. The Cisco or the Yahoo or AOL of the 1990s, the Charles Schwab's, those really kind of trademark names that were the leaders of each of their individual trends. And same if you look at, let's say, the COVID era. I just want to kind of just for, this came out of this nice basing structure here in 2021. First pull back to the 10-week moving average, then we blasted off to new highs. Same with Tesla coming out of this big base in 2020. First pull back to the 10-week moving average, then we pushed up to new highs again. So the reason I want to have this AMA today is if you look at a lot of these different leaders, and you look at even what we're focusing on here, is, okay, who are the strongest stocks? We want to really get these, especially on pullback to the 10-week moving average. I know we have, for example, GEV, and it's been a tremendous advancer, but we're yet to even pull back to that 10-week moving average for its first time. And rather than kind of get put off by the fact like, wow, this has had such a big move, think about how incredible the demand is for electricity generation. If you look at anyone who is, don't take my word for it. If you listen to Eric Schmidt, if you listen to Sam Altman, if you listen to Elon Musk, the guys who are at the core of the AI revolution, who have their fingers on the pulse of the real demands and needs, a lot of them will tell you that the only thing that will limit AI capacity at this point is not even going to be NVIDIA chips. It's going to be the amount of electricity that they can get to their data centers. I believe it was Texas recently. It was just, I think they're passing some laws where if there's a shortage of electricity, it'll come at the expense of data centers. They're going to, thankfully, they'll keep electricity for households before data centers soak it all up, because these AI processors take an incredible amount of electricity. So that's reflected here in how much demand there has been for something like a GEV. Same with, if you take a look at NBIS, take a look at this tremendous strength. We had our first kind of basing structure right here, and we've pushed up to new highs. So this is an interesting time, because rather than feeling like so much is done and like, oh, the market's gone too far, you really want to look at the highest quality stocks, and you want to be looking for those pullbacks at 10-week moving averages. That's where my mindset is right now. If we take a look at Oracle, for example, you can choose what your risk tolerance is. Oracle is kind of like a larger company, obviously one of the largest tech companies, who is also on the pulse of AI. It won't go up likely to the same extent as something like an NBIS, which is a young upstart. But Oracle is also showing tremendous strength, especially off the bottom. This is yet to touch its 10-week average for the first time. And this is a real character change for Oracle. Before that, this had been much stodgier and quiet. This has really been pushing very strongly. If you look at even things like an STX, we just had that first touch of the 10-week moving average after coming off the bottom, and it found support. So a good example in real time. So we want to find really those quality top tier companies. That's where my focus is on. AI is the main theme. I think the secondary theme is crypto and kind of fintech. And so you can see things like Robinhood as well has been a great trade for us. And this is yet to touch its 10-week moving average. So we're watching that very closely. And so I just want to have this call to kind of bring the perspective. And also, rather than kind of people feeling like, oh, it's gone too far, I need to wait for this another big bear market to come around. Again, that's the irony of markets. By the time everyone feels comfortable to buy, that usually is the end of the bull market. And often these even shallow short pullbacks to 10-week averages or 21-day moving average present really the best buy opportunities, but you have to be focused on the absolute best and quality stocks that are out there. So that's what our focus is all the time. And really, that's why every position, we treat this like a portfolio, so people have a good sense of understanding how to put all these moving parts together. It's one thing to just, rifle off some good stock picks and good stock charts, and that can be helpful. But understanding how to put that together in like a portfolio process, like how much weight do I put on a stock? How do I build into a position? That's really, it's really about taking all of these themes, all of these ideas, but then being able to kind of bring it down into a simple process where you can step in a bit at a time, manage risk. Again, what I'm proud about is not even, it's great that I've had these nice winners, but there was never a period where there was significant risk to the portfolio. We always kind of track when we put on new positions, like what would be the risk to our capital if these all hit their stops. And we never make that past 2%, always 1.5%. So to be able to have sat through the tariffs, not got hurt, reposition in leaders, and never take on, if you just buy a basket of growth stocks, that basket could fall 20-30% really quickly, so being, it's one thing if you have big profit, but if you're initiating exposure and that's the kind of risk that you have, to me, that's just, it's not acceptable to me. That's where, personal discretion comes into existence. But for me, it's always important to have risk front of mind as we're looking for these kind of life-changing opportunities. So that's kind of the big picture of where I think we are. That we're focusing right now still on these infrastructure stocks that are pulling back. We're starting to kind of identify some of these use cases that are coming to market. We recently purchased some Tesla, RKT, and SOFI. These, RKT is trying to become kind of the Amazon.com for lending and mortgages and all of the rest. So they want to use AI to be able to bring all of that together. So very interesting. SOFI's trying to do kind of fintech in terms of offering banking services and the rest. So it's some interesting parallels as well with fintech and AI, and Tesla, of course, with robotics and self-driving and all the rest. So consistently trying to find these great companies. We always, once we purchase a stock, like we bought Tesla, we always buy at about a 9% position size. We sell 1/3 of that or 3% at 2 times our risk. Once that happens, the remaining position is risk-free, which is just a lovely way to kind of build a portfolio, take a risk out of it by selling very little once we see some strength. And then if you're right about it being a leader, you can sit in there for weeks to months and hopefully find the next Cisco or the next Qualcomm or the next big monster winner. So that's how we've been positioning. That's what we're focused on. Rather than kind of being worried about the market pausing here, I think it's an opportunity if there's any kind of pullback to build into these leaders. And really the next big key is going to be the Fed's discussion on Friday. We'll have to see how that goes, but we won't get too deeply into that. Let's get to a Q&A so we can see what everybody wants to talk about. It'd be fun to chat with everybody. So again, just a little quick reminder for those who do are interested in this. We're going to have a short-term offer where you can get 2 months for $99 on the low-cost tier or $159 on the high-cost tier. And the higher cost tier comes with alerts. It comes, if you sign up for the annual, there'll be a 13-month free, and that comes with a Discord group and courses. And take a look at the site, or there's always my colleague Sinead can answer all your questions. It's really a passion project for me to do all of this. I trade for my own account, so I'm fine. I like to teach. I've also been a past finance professor, so it's more of a passion project. And so this is really built in a way to reflect what my actual routine is all the time. So if you find some interest in it, you can check that out. But let's go to the Q&A. Patricio says, Matt, thanks for doing this. I appreciate it a lot. Traction on new buys has been difficult for a while now. However, from what I understand, based on the precedent you've been using as your base case, you don't foresee a touch of the 50-day average in the near future in the indices, at least not before going much higher. Did I get that right? I think that's I mean, the 50-day average is like 3.5% lower on the NASDAQ. So, I mean, it's not an impossibility. One of the tools I use that's become a real hallmark for me is my FOMO indicator. This, again, this looks at the number of stocks on the NASDAQ that are above their own 5-day average. When 80% plus of stocks are above their own 5-day average, people have gotten really excited in the past week. Think about it. If 85% of stocks are above their 5-day average, basically every stock has been bought up in the past 5 days. And that tends to represent FOMO. And so you can see even like last Wednesday, we used that to de-risk SOFI. We used that to de-risk RKT. And we use that to raise our stop on Palantir to kind of, even as we have this little pullback, for it to not be too painful at all. So I don't know if the triple Qs will get down to their 50 or not, but what's important to me is once we get down to the lower end, so the upper end is fear, is FOMO, the bottom end is fear, and you can see where that usually overlaps, at least with good short-term entries in the market. So for me, what's critical is when we get those pullbacks, rather than panic on the way down, it's once we pull back, if that pullback is happening just as we get to fear, that's very normal. When we had this pullback here in the beginning of August and everyone thought it was the end of the world, we used that to kind of turn around and start looking for buying opportunities in the short term. I mean, this is not that you can never go lower, but the character will change if it's a bear market. If it's a bear market like we have here, and why we went to cash is even when we got to fear, when you get to fear readings, the market can't rally. That's telling you that it's a very weak market. If you get to fear readings and you bounce immediately, it's a very strong market. So as long as the character remains positive, this is an environment where as we pull back, we want to do buys. I would actually welcome a pullback a little bit lower. It'd give us a great chance to kind of buy some of our buys that are near that 10-week or 50-day moving average. Eric says, do we receive in-time trade ideas? So what we do is we set up all of the trade ideas always the night before. They also come with a daily market update where I explain the thoughts and the reasoning and all the rest. We update all the sheets. But for those who are with the insider tier, the higher tier, there's also, we have a WhatsApp group and you get real-time alerts whenever any of these triggers happen, whether a stock triggers a long, whether an existing position triggers a stop, whether a hedging options trade happens. We always send out automated alerts to kind of let people know that, hey, that idea we were talking about last night, it's at that price now. Patricia says, Matt, do you still like RBRK? The group has been looking weak and has been underperforming since early June. Besides net, seems like the leader in that group, judging from relative strength and the EMA's position, etc. I still like Rubrik personally. I still have a position, so does the membership. This is one where you had to really start at a proper area or you would have been stopped out a million times. So if you look here, our cost basis is right about where it is now, $86. I still like it. I think, one thing I like to do, and I've kind of gravitated to more and more over the years, especially when there's a situation like this, because, they had good earnings, they have great forward estimates, but they did buy a company, they did issue convertible debt. So that can often lead to a lot of volatility as the convertible bondholders will hedge with stock and all the rest. But this is why I love to look sometimes at the close only prices. If you look at just where did things close every Friday, you can see this is not really a stock that seems like it's under distribution to me. It seems like we're in a basing structure. And I think they can really be one of the leaders in data security. And they're also, with the recent purchase, trying to be leaders in bringing AI systems to market. So, it's one where risk is managed. Fortunately, we bought it at a good enough price, but, kind of looking past the daily volatility and looking at the weekly action, to me is still normal, although a little odd on the daily. I'll give you that much. Joaquin says, what type of traders would you recommend your product to experience-wise? It depends. Obviously, I'll be honest, if you've never traded a share before, you'll probably be overwhelmed with what we do. But we have a lot of education. If we go to that's the wrong thing here. Just to kind of give you an idea of what there is. For everyone who signs up, if you sign up for the annual membership, you also get the active growth investor course. I used to sell this for $1,300. Now I just include it with the annual membership because it's just so important. Like this is a 10-hour course, which is like was filmed nicely in a studio, and it's broken down by the entire process. Like in my opinion, this alone is worth the membership. It's great. There's examples. It shows you buying, selling mindset so much. But for even those who sign up just for the monthly memberships, if we go into the insider membership here, we have an onboarding mini course, and it explains, at least in a simpler format, the whole process, our buying process, our selling process, how we interpret the markets, how we hedge for earnings. So for someone definitely who has, the basic understanding, you should know what moving averages are. You should know what a candle chart is. I don't think anyone here, or I assume most people here have those basics down. And the rest is, to be honest, if you want to learn the real way to invest, like the whole process, and not just be given another 5 different buy indicators, which is, buying. I always try and say that, someone who just looks at buying indicators, that's like a race car driver only thinks about acceleration without thinking about braking, turning, handling. It's just one part of it. You won't win a race if you can't brake your car. So, I mean, if you can't use the brakes is what I'm saying. So, if you want something that's more realistic and really the whole process, that's really where we live, so it's why we don't really do too much marketing, because usually it doesn't lend so well to marketing, but that's what our process is all about. Taylor says, hey, Matt, can you talk through your mindset when deciding to sell a stock versus holding for a longer move? For example, can you explain why the hypothetical portfolio sold Palantir but held GEV or Hood? Thanks. Appreciate everything you do. My pleasure, Taylor. Let me take a look at that real quick. So one concept, Bill O'Neill did talk about would be like base count. It's not a big part of my process, I'll be honest. But if you look at Palantir, basically, this has already had many basing stages. Like this move is not as young as something, let's say, like a GEV, which is much younger. Also, I'm not someone who's big on valuations. I won't ignore stock because of valuations, but the higher the valuation, the more you're becoming priced for perfection, and you can have more downside. So in this case here, when trying to figure out, who do I want to keep and who do I don't want to keep. If we look at Palantir, one, not only was it a later structure, also this had been within this kind of this climbing range here for a few months, and so we had this extension higher out of this on the earnings reaction, all the rest. I prefer to sell into strength. It's always much nicer to sell up at 180 than down here at 150 or 140. So much of the profit ends up being gone. And so part of it is looking at the general portfolio exposure. Who are your top tier stocks? If you do want to take off, exposure, it's part of it is a process of elimination. Part of it is looking at how extended the stock is over time. Part of it is looking at the valuation and whether it's priced for perfection or not. And then after, the short-term timing of it is what we look at. So those are kind of like the deciding factors I go into. But most stocks, when we buy them, if they're very strong and they break away quickly and we can de-risk them and they're on a leadership, their leadership quality, the aim is to hold them for several weeks. The ones that don't stick around are the ones where you buy it and the stock falls over and you have a 5% loss, you have a 4% loss, and you have to exit and move aside. So if the market lets us and the reaction's great, we'll sit in it a little bit longer. Gal says, you sell 1/3 and move the stop to break even. So the beautiful thing is let me just kind of show you the logic behind it. It's like, let's say you buy 9% at $16.90 and your stop is 16.05. Sorry, 16.05. You have this 85-cent risk. So if you sell 1/3 at 2 times that risk, so if you sell it at $1.70 higher, you de facto your average price will fall to where your original stop price is. So by selling 1/3 of the stock at 2 times the risk you had on originally, you never even have to raise your stop. You're immediately at break even. You can't lose money on the trade anymore. So what's very nice about that is if you look at a stock like, let's say RKT, if we look at what we actually did with this stock. So we bought RKT at 16.90. So that's the example we saw here. Just a little calculator I leave for myself to quickly calculate things. So we bought that at 16.90. The stop was 16.05. I haven't touched that yet. Where is that? Here, 16.06. This is where the stop was. So we bought that at, apologies, We bought that at 16.90. We sold 1/3 at 18.60. So you have only 6% left. You give up a little bit of your position. That's the downside. But since then, the stock has pulled back a little bit. If we take a look at where we had this nice lift higher, we sold some into strength. It's pulled back. But even with that pullback, because we were able to lower our adjusted cost basis, we still have, even after this pullback, we still have 15% of breathing room. And it's just normal for stocks to kind of bounce around after you put them on. And so it's a nice way to take risk out of the portfolio, but then still give the stocks that normal breathing room and not just get stopped out of everything all the time, which is such a frustrating thing that I think a lot of people suffer from. And for anyone who signs up, just so you know, like every execution we've ever made is in this sheet. Like it's a very, very, I think, unapologetically and uniquely transparent membership. Every open position every day since we started is here. Every actionable idea we ever had as a plan, whether it executed or not, is here. So everything is really there to you can kind of, just on the summary page, we just limited to the recent few, but everything can be viewed when you go back in time. Ulysses says, Matt, thank you so much for hosting this. When you buy off the 10-week moving average bounce, do you set your stop at an 8% like O'Neill, or would you under the 10-week? So what I do is, personally, I use a 5% stop. I find 8% is a little bit too much for me. And even if you look at what Bill would say, he used to say 7.5, 7, 8, and he'd say, hopefully you should be out before that. So I try and ensure that the 10-week, pullback is in a leading stock. I want to make sure that pullback, that 10-week average, already saw the stock pull back at least 10% plus, so it's already had a fair amount of correction under its belt, and then I give it a 5% stop. I prefer that way because oftentimes, this is a good example. Let's just say right here, if you bought on the 50-day, you can survive the back and forth action. If you waited for kind of a rebound, then you bought above a candle, and then it just pulls right back to the 50, you end up selling on the 50. And then it just rebounds again without you. Like a good example is what did we buy? Rubric is a good example. We bought Rubric around 86, right on the 50-day area here. That's the only reason why we survived all of this. If we would have waited for strength and then bought up here, and then we would have been stopped out. So I like to buy on the 50, and I give it some breathing room, but I always preface that by making sure it's a leading stock and the rest of the important variables are there. Rick says, Matt, how are you putting those indicators on your TradingView chart, like the federal funds or the NASDAQ 5%? They don't come up in my TradingView Pro. That's a good question. Let's go to a clean template here real quick. I'll show you a little tip and trick. So a cool thing about TradingView that you may not be aware of is if you go to Fred, this is the Federal Reserve Bank of St. Louis. They have all economic data. They have so much. Any Federal Reserve data series is here. If you take the code and you go into TradingView, let's see here, and you go, and instead of looking at indicators, if you look at the plus key and you put that in, you can add it as an indicator. So you have to add it as like a new pane to your chart, and it'll come up at the bottom. So the federal funds, this high yield index, they're symbols, they're not indicators. For the FOMO indicator, I actually, to make it easier for people, if you type in FOMO, I turned it into an indicator because most people don't realize you have to add it as a symbol, and it's a little bit clunkier to do it that way. So for the FOMO, or the percentages talks about the 5-day, you can use the one I created. It's free. And if you go to the indicator itself, you can select between NASDAQ and the S&P 500 if you want to look at one or the other. So that's a little helpful tip. David says, if you de-risk 1/3 of new buys at 2 times the risk, when would you add? And if you do add, how much? And do you treat that as a new buy? And again, you de-risk it. So that's a very good question. Every new buy follows that same kind of process. Every new buy is 9%, and it's a new position. And when that rallies, I take 1/3 off again at 2 times the risk. Now, that's not really necessarily how I always do it myself personally. If you go through the course, I use something called a dollar stop. That's what this is here, and that's closer to how I trade. But for a membership, I was trying to do it the way I do it. But let's say someone signs up early on and they buy GEV at 392, and then after someone else signs up 3 months later and we buy it at 491. The thing is, if I make it all one position, no new buys are ever helpful for anybody who signed up after the original position. So it makes it very difficult for people to follow along or get value if I just always clump them all into one position. So that's why I kind of break them out separately. It's also easier to manage. You can kind of keep better track of which purchase did what. So for the sake of the membership, I always de-risk and then I just track them as separate positions. So if, let's say, for example, AMD, if someone was there for both of them, great, you have both buys. If someone showed up a little bit later and there's just the second one, they still get value out of it. If they would just, if it would all get clumped into one buy with a really low stop price, it wouldn't be very helpful for them. So that's the way we do it. SC says, "Hey Matt, thank you for doing this. Appreciate it. My pleasure. Given the current market is the sector given the current market is in sector rotation now, would you trade other laggard stocks which have a setup, or just sit and wait for the leaders to pull back to the 50-day moving average? Thank you." There's one concept I've learned, and I was having actually with members. I think it was in our Discord, or was at the last live call, but we were just talking about this. Where that book by William O'Neill is such an incredible book. It's fairly simplistic. I mean, it takes a lot of reading, but it's one of those rare books where it could take you 10 years to internalize or more, all the little subtleties and things. And I was just saying how one of the concepts like leadership is just such a critical one that even though you can understand it, oh yeah, you need to be a leading stock, like it is a top priority to always be in those leading stocks to me. If you want to have outperformance, if you want really great returns, you need to identify those leaders. So, the way I like to do it is if I do see some rotation, which I think falling rates can cause some rotation, and sometimes it's not rotation, it's just kicking off new leaders. Like new leaders can appear. I still think the overarching driving force of this bull market is AI. In the 90s, it was the internet. In the 2010s, it was, let's say, software as a service. Now it's really AI. And so even something like RKT, if you go over to their investor relations site, you can see how they're really trying to retool the whole company with an AI first mentality, with all of their data to kind of transform the home buying process. So, I want to see strong fundamentals and earnings. I don't want just people to kind of keep telling me AI, AI, AI. It's got to be something real, not just hype or fluff. But if I am going to look at it as a rotational idea, I want to know there's still strong growth, not just for the sake of rotation. Jay says, any discounts for those who have previously purchased the course? Jay, send an email into the general email, which is carusoinsights@outlook.com, or you could also go to the website, and my colleague Snea will help address that for you. I'm sure there's something we can do there for you. A separate Jay with another question. What is your hedging strategy do you use going into earnings? So I feel like earnings have gotten wilder and wilder. Actually, if you take a look at, where is that? Just real quick. It's such an important part. There we go. I started doing some workshops during the year. I did an options one all about hedging earnings, hedging profits, and all the rest, but we don't resell it. Maybe we'll do them again next year. But even for the membership, if you do sign up, as part of the onboarding course, I do talk about how we hedge for earnings. This is why we run two different strategies. Some people just can't do options. Options are my preferred way to hedge for earnings. It's also my preferred way to hedge when a stock is very, very extended. So if you take a look at Ethereum, we bought this at 1974. Oh, sorry, no, that's the average. I think we bought it at 20 and a half or something. We sold part. We bought a half position, so we sold 1.5%. So we have 3%. So our cost is 1974. And if we take a look at the extension, one of the things I like to watch closely is how extended stocks are from their 10-week average. This, in the short term, looked tremendously extended. So actually, part of it is a little bit good fortune. I'll take the fortune when it comes. But we bought protective puts last Wednesday, right around, I think, the closing price. So we bought the $30 puts going out to September 12th for $1.10. So if a stock's very extended, if you just sell the stock and you have something like Cisco, congratulations, you sold your stock worried about a 10% pullback and it went up 300% or 3,000%. If the whole strategy is to find these amazing companies, it's a little counterintuitive to sell just because you think it's too extended. But at the same time, you do want to protect against the pullbacks. So the way I've kind of gravitated in those situations is I'll look at what's a normal pullback, usually 15%. tends to be the 10-week average or the 21 average. In this case, we looked at it about $30. We won't get into all the details of it. And so those puts are usually pretty inexpensive. So we bought them for $1.10. It's about 3% for a month. So if Ethereum does pull back, for example, from where we bought it, if it pulls back to $30, that's a 15-16% correction, let's say. If it's a normal pullback, it's actually a great buying opportunity. The problem with buying on pullbacks is no one ever wants to do them because you're already in the pressure of the stock falling. So by buying these out of the money puts, if the stock just keeps going higher, the puts don't cost too much money. At 3%, I mean, that day alone, the stock was up 5%. So it was less than even the profit of that day. So 3% is not too expensive. If it keeps advancing, you still have all of the upside. But if there is a pullback, once it gets down to that level, you're not kind of worried like, oh my goodness, what if it goes down to the 24 now? And then it's really a problem. You have protection at 30. Then you can kind of make a choice. This is the way I like to approach it. If I don't like the character, if it's a bad break, if it's concerning, if the market has a negative catalyst, something goes on that says, whoa, I don't want to put on more risk right now. Well, it's great. At least my floor is $30. If the pullback is normal and nice, when it gets to $30, I can say, well, I'm comfortable with the way the stock's acting. I can use these puts as a way now to be more aggressive and buy more stock without worrying about more risk because I had preemptively bought puts for cheap when they were higher up. So that's how I deal with hedging when stocks are extended. That's my preferred choice. Sometimes we'll sell a little bit of stock. So when it's earnings, we'll also buy puts. We'll usually buy them a little bit closer. The cost and the strike we choose kind of depends on what the volatility of the stock is. With Robinhood, for example, the reason we have 2 4% positions is that we sold a little bit of stock instead of buying puts because the puts were just kind of very, very expensive that time. And so we opted to sell a little bit of stock instead to hedge and lower our adjusted cost basis even further. So ideally, this pulls back to its 10-week and we can buy it all back and more at a less expensive price. But definitely hedging is very important for us around earnings because the more you concentrate positions, the more critical earnings hedging becomes. If it's a 5% position, not a big deal. If it's a 20% position, it's very important. If it's a 30-40% position, it's critical. So a big part of our process. Steven says, thanks for doing this, Matt. Much appreciated. My pleasure, Steven. When you're adding on or entering at the first 10-week moving average touch, are you waiting for strength to show up before entering, or are you attempting to enter at the lows of the 10-week? So I personally like to buy it right on the 10-week. I know some members, it's always that same dilemma, and I get it. Some people prefer some strength, but again, kind of going back to that rubric example, sometimes it's kind of like a false sense of security. You see it come up, but then you buy it and there's still chop. So I prefer to buy on the 50-day. I always have a 5% stop. So my risk is still limited, even though I'm buying it on the way down. I'm in a sense, trying to control risk by not doing that on all stocks. It needs to be a leading stock. It needs to have, the right theme, the right relative strength, the right price action. And then I'll still limit it to a 5% loss. But if you get it right, it works out quite well. George says, Matt, thanks for doing this. My pleasure. Learning a lot from you. Do you play the short side too? You know what? It's funny enough. Again, if we go to that QQQ chart and we go back to, where is this here? Let's go back in time a little bit. Maybe I'm showing my age a little bit, but where is this here? So this was my first day trading pro. That was not a good time. And Marcus had an awful year. I still primarily played alongside that. It was different. It was market making. It was day trading. It was a different ball game. It wasn't position trading like this. But my mental makeup, I'm just someone who does better with the long side. I'm capable, and I just don't like trading the short side. It's not a style that appeals to me. I'm not very good at it. I'll be honest. It's not one of my strengths. And so I prefer to just kind of let bad market environments go by and then find ways to make money. Like I said, even this year, I was able to it wasn't a phenomenal year, but to be a first-year trading pro and make money coming out of this debacle, playing the long side, I'll call a win. But I'm really not a short side type of guy. James says, do you trade crypto ETFs the same as normal stocks? Do you find they have the same supply demand dynamics as stocks? I do. As you can see, we have IBIT and Ethereum. I don't trade all the other little things. That's really pretty much the only ones that interest me for the moment, at least. And they do seem to have especially IBIT. We've been trading IBIT since it came out for quite some time. I find actually, if you look at crypto before and after ETFs, you can see what the presence of more developed financial markets can do. The characters really changed. And so I find that it does have a lot of similarities. They trade the same way. Eric says, how do you balance selling a third at 2x multiple with trying to position size to make notable gains in your portfolio when you have a true market leader? Really appreciate this, Matt. Much respect for you. Thanks so much, Eric. So look, personally, I don't myself, if I think it's a leader and there's great action, I don't typically sell at 2 times the risk personally. When I was a market maker in the early years, I was a young guy. I was also a finance professor for a few years. I was the president for the Canadian Society of Technical Analysts. Like I have a lot of experience in teaching people and even running this membership. I always joke with members, this is the first real job I ever had, besides just trading my whole life. So it's the first time I had to deal with other human beings in a sense. People have a hard time losing a lot. And so I found since I started instituting this, it's easier for everybody to live with. Once it's de-risked, the stress comes off. I'm not William O'Neill. I try and do my best. I'm not Stanley Druckenmiller. I think I'm a good trader. I'm proud of my track record and what I've tried to accomplish. But it took many years to kind of build the stress tolerance, the understanding, and all of this. I think it would be kind of like saying, I can drive my car quickly. Give me a Formula One or a NASCAR to drive. Just as I can drive a regular car, there's no way I could drive at those speeds and perform without probably crashing and killing myself. So I think if this was a direct replication of exactly what I do, it probably wouldn't be helpful for almost virtually everybody. So I found that was an element that is helpful for people, but I always let people know, and some members do it the way I do, where they don't de-risk it at 2 times the risk, but then there's a much higher failure rate because you don't get your stop down to break even so quickly. You're more likely to lose. So I just found it's much easier to live with for most people when you take off the risk. So how do we then still get concentration? Well, you'll notice I try and have multiple entries on different stocks. So even though we de-risk GEV twice, it's still a 12% position. And again, this is designed around a process for most people to follow. Some people come around and say, man, I want more of the aggressive returns. Well, no one's stopping someone from, instead of having a 9% initial position, to making it a 15% initial position. What matters is really kind of the structure of how it all comes together. And that's where, that's where personal risk tolerance is. And they have to kind of figure out what's right for them. But just besides the actual size of positions, one important element, and especially if you go through the course and if you go through the buying guide, like I have, that's kind of when I was a market maker, I noticed early on, I was always making money every day, trading my process, which was short term. And a lot of it was fading moves. If there's strength, sell into it, buy it back, and trade like crazy. A lot of fun days. And then I'd be trying to, diligently implement William O'Neill's process. And it was funny. I remember it was one point where I was on a real losing streak with the can slim type of stuff and the cup with handles and all that. And I remember looking back, I'm saying like, what is up? Like I'm the same guy, the past 3 months, I'm making money every single day with my day job. And then after I'm trying to implement this stuff and I know this stuff in the book is great. I love it, but why am I always losing money? And that's kind of where my process, I kind of came down to the concept of, I think what Bill taught, the fundamentals, everything is the core of how these stocks function. If you look at how he describes the charts, I believe the bases will show demand and supply. They'll show accumulation. Do I have to buy at the breakout? Is that the only time I can get into the stock? I said, I can trade a company out 50 times in a day. For my market making business. Why am I restricting myself to only one specific perfect entry that has to happen? If I missed it, I missed the whole stock. So what I learned to do with time is I have a bunch of shorter term entries that I'll use with reasonable risk that I use when the chart is right. It shows accumulation, it's showing relative strength, it has the right fundamentals, it has the right theme, etc. I'll find multiple ways to buy the stock at different buy points. So that's how I still work to get good concentration, even though maybe the position sizes are a little bit smaller, you take a little bit off into strength, but you can still find multiple entries. Sorry for the very long answer to your short question. Tad says, Matt, how do you find the leading stocks you want to buy? So, I always joke, such a big, I think, undervalued thing of what I do each week for members is I always provide a leaders list and then a cars list, which is like a subset, it's a filtered list. And each week I scan with a lot of different screeners. It's at least a couple of hours every week. And that's only because, at least an hour to 2 hours every week. And that's because my lists are already up to date. Like I really like to be thorough. And it's really about kind of going through these lists each week and seeing where the relative strength is building, seeing where the themes are, who are the outstanding stocks, what are the fundamentals for the different stocks in the different groups. You catch things like, there's CLS, which makes components for data centers. There's also JBL, both are strong stocks, but CLS is the leader in that group. And so you slowly piece together, and it's kind of like a day by day approach, and you eventually have a really good understanding of who are the leaders. And so week by week, like what's in the list now? We have 77 symbols. Some weeks no symbols change. Some weeks, 3 or 4 added, 1 or 2 are removed. And so it's a list that constantly stays in flux. And it's that way we always try and make sure that it has the best of the best. And a lot of that is kind of just bottom up. You got to go through the different stocks, the different screen scans, and you find out who's working. Taylor says, can you explain how to differentiate between a normal bull market pause and a pause that might turn into a correction? I know the overall goal is to not give back all of your gains. Do you follow similar rules to Webby and the IBD folks to reduce exposure, or do you have your own rules? So that's an interesting thing that you bring up. And as soon as you get into the selling side of things, that's really where it's like your own personal goals become such a big part of it. Like I always say, a lot of the entry techniques a swing trader uses don't have to be very different from what a position trader uses. The difference is what you're building into, what you're expecting to get, what you're trying to accomplish, and all of the rest. So my process is really centered around basically trying to really get the most out of these 3, 4 to 5 month up cycles in stocks. So that's my personal kind of wheelhouse. And usually if you can get those bursts of strength and lock in the majority of the price. If you go over the market, you'll notice you always get these this is April to July. This is basically November to March. It's always 3 to 5 months you get really good, strong, and then you have a normal pause. I mean, even this in reality is a normal pause and we went higher. The key is to avoid the really bad stuff. But also going into those pauses, you only want to hold on to your highest quality names. You don't want to go in with your full exposure. And so as the market kind of extends itself, there's a lot of different tools that start to come around that show a character change in the market. It's almost always the same. There's always variations, but there's a lot of similar flavors. And so part of the selling is based on the individual stock. Part of the selling is based on the market, the way it's acting. And so then that's how what we do as well is I have here, you'll see like ideal portfolio exposure. I like to look at the individual stock positions, but at the same time, what's the market environment? Because it's really a combination of the two. So if the market's deteriorating, like if we look here real quick, I'll just show you what I mean. We go back to, let's say, beginning of this year. Like we had the market was like in a 50 to 90% investment mode. By late February, this is 20 to 50, and then by the time March rolled around, it's like basically you should be in cash in this market, and then once the bottom was in, we started to rebuild. And so by trying to kind of stay within what are reasonable expectations, but we're not always exactly perfectly there. It's just like we take a moment, we look at the market, and what's the market telling us? If the market says you should be 50 to 90, but you have the best stocks in the market and they are like on fire and they're the clear leaders and you're at 120, well, okay, there's a reason why you've nailed the best stocks. But in general, there are some elements that are starting to cause some concern. Maybe if you see weakness, you should come off of margin. And same with if you're in that 0 to 30, you can be 0. If you see a couple of, you can go to 18 or 27, but you probably shouldn't be fully invested if it's a 0 to 30 market. And that's kind of how we balance between the stock action, the market action, and then you naturally get down to what should be the right size. I think it's hard to kind of make it a one rule fits all, because some markets will end with like a peak and will roll over. Most market tops end kind of like more of a sideways basing period that ends up breaking. So you have more time and more signs. And so we have different tools for different environments. So it's a big answer. It's a big question to answer in a short amount of time, but that's the general process that we follow. Brian says, hey, Matt, I really enjoy the way you teach and explain. What's your thesis on Ethereum? Do you or will you trade this like a typical stock leader? Yeah, so I mean, I really, again, I'm not a crypto expert. It's not like, it's not my wheelhouse where it's my specialty, but I understand the basis behind it. I understand IBIT. Again, even when I was a market maker for many years, like my background was a lot the mining business. So like I understand the whole gold thesis, store of value and all of that concept versus the Fed and all that. Built a lot of my economic understanding actually. And I also understand Ethereum, which is, I think, part of the massive kind of fintech transformation that's taking place. So I also get why that's such a big transformative opportunity. And so to me, the way I'm treating these is that I think these are, especially right now, Ethereum has taken kind of the title as the leader in the crypto space, not the biggest, but like the stock following that leader type of action. And so that's why most new buys have been kind of pivoting towards Ethereum. And that's what we're trying to kind of get a bigger position in. But I think there's space for both. And I'm going to be treating them like a leading stock, basically. Donald says, how do you screen for leaders or your criteria for determining leaders? So let's see if I can just bring this up real quick. I use, for screening, I use Market Surge. There's other great tools. I use trading. I use trading. I don't usually use TradingView for screening. DeepView's got great screening tools. There's TrendSpider's got great screening tools. It's just for charting, my preference is TradingView, and for screening, my preference is Market Surge. I'm a bit of a creature of habit, so that partly this explains it too. There's a number of different screens that I run. A lot of these are in the course, but basically I'll run for fundamental scans. Sometimes I just want to say, like, which stocks have sales acceleration, which stocks have high composite ratings, which stock have record annual earnings per share. There's a lot of technical scans that I'll run. I'll look for 3-month relative strength, good up-down volume with strong sales. Just really, I have different names for all these different types of things, but 3-month relative strength with sales acceleration or earnings acceleration. So different weeks I'll go through different, sometimes I'll test some new ones out, but week by week I'll run different screens just to make sure I'm not missing anything. But that's why it takes a lot of time to go screen by screen. And you want to have a good idea of which stock is doing which, not only from a chart perspective, you want to see fundamentally, is there something that backs it up? Is it a stock that's just, for example, like, what is it here? Let's say like a quantum stock, where is this all just based on something they hope to build? I'm not someone who tends to focus on those stocks. It's kind of like a biotech. I don't know what the product will be. So for me personally, those tend to be like a no-go. I don't usually trade those types of stocks. So you get to see, even though it's got a good relative strength rating, that's something that makes me nervous personally. For others, it's not a problem. When I was a market maker, it didn't bother me, but I'm trying to put a big part of my portfolio and build a position in stock. That's something that bothers me a little bit more now. So it's quite a process that I do each week, and that's how I end up with my weekly lists at the end of the week. CB says 10-week pullback buy. Sorry to be repetitive, but curious on the mechanics. Sounds like you buy right as it hits the 10-week price, or do you wait for some sort of confirmation after the line is hit? And is this typically an add-on buy, or do you also start full positions on the pullback? So I personally buy it. Well, you can see here. So for example, for right now, if we look at GEV, we have 578. So if we look at GEV right here, I have a little tool that tells me this bar, it will touch the 10-week moving average at 578. So this is a little thing you may not have noticed, but if you look at the current value of the 10-week moving average, which you can see right here in red, the current value is 583. So why 578? Well, the current bar is part of the moving average. So as the stock starts to fall, it'll start to bias the moving average down a little bit. So I take that into consideration. Like, I want to buy the stock typically where it'll be actually touching the moving average, not where the moving average is right now. So I'll buy it as it gets to that average. Amit says, will we get courses with the monthly subscription? So it's not the full course, but there's this onboarding mini course, which is smaller and covers the core process of the strategy. Vinny says, we've been in this bull market quite a bit now. New leadership will peek its head out over time, as we know. Do you evaluate with the exact same criteria for new leadership mid-bull? Yeah, absolutely. You should see proper basing structure. You see that relative strength. It should be on. I mean, I absolutely expect new merchandise to come up, and that's why we've started looking at things like RKT and SOFI, and Maybe Tesla at some point will get back into gear. We'll see. That one's a bit of a stretch. I'll admit it's a little more on what I think could be than what is at the moment. But absolutely, it's a pretty. I try and make it as repetitive, but without just being a black box. Like I mean, I do want to have an understanding of what's going on, but at the same time, I want it to be a structured enough process where, if it's just a wild process, you can miss things from cycle to cycle. I find once you can kind of make it a fairly simplistic and reoccurring process, it's easier to kind of always catch the quality things as they rotate, even within the bull market. James says, thanks for sharing your knowledge and system. My pleasure. Rather than selling a third at 2 times the risk with a small gain, would you rather move your stop up to break even when you have an 8% gain and keep a full position? There's a lot of different flavors you could run. The reason I went with a 2 times risk and take a third off is because if you're in a choppier, more volatile environment, it allows you to sit through position. And like this has been a pretty forgiving bull market. This is one where you didn't want to take anything off because things just kind of kept rocking higher. But there's other environments that are just choppier. They're a little more frustrating. So just to kind of reduce the amount of turnover, like virtually, we have a lot of members that are professionals who are members of Crusoe Insights. There's some hedge fund managers, there's some investment advisors, but the most people have other day jobs, or even if they are investment advisors, they have all their clients to take care of. So the aim here, like part of when I kind of put this together is I keep in mind, not everyone is a professional trader sitting at the desk that can trade 20 times a day. Like I try and think of the amount of turnover. Like it's a really thoughtful process. Like, I don't want 20 stocks going off every day for buy and sell. I mean, for most people, if you're in a meeting and you come out and there was 24 trades you're supposed to put on, it's not really very helpful. So part of it is also kind of reducing the churn and the turnover. But that's why, for a rule like that, the point is to kind of be able to de-risk a position. So in a choppy market, you're not kind of cut to pieces, or you want to reduce the drawdown. Do you want to go for more exposure if it goes well, but higher chance of failure, or a little less exposure and less chop and turnover? I mean, that's the choice. For the membership, I think for what most people, what would be most convenient for most, I think is what I've selected. But it's a very reasonable, like, slight adjustment if it's something that you want to do. The logic is consistent, so I totally get it with you. CB says, selling and locking in profits. Could you discuss a bit more of your thinking on this topic? It's so difficult to sell winners. For winners, I've been using breakouts of the 21 EMA in the 50-day 10-week, or selling some on a break of a top channel line. What else would you add other than the sell 1/3 rule you mentioned? Seems it's done to reduce risk more than protect profits. 100%. That's a rule that's at the start of the trade. It's not a rule that's at the end of the trade. Without going into too much detail, I really love upper channel lines. I think that's important. Another important thing is if the beautiful thing about what William O'Neill, was not just the fundamental basis, but also the explanation and the character of what these leading stocks should act and do. So it's kind of like you get to know them as a person. So if it's a leading stock, one thing that helps me a lot of time is also the time criteria I have. Like if it's a stock breaking out of a base, it should take at least 16 weeks for a stock like that to put in a major peak. It's very, I mean, if you look here, even though we went into that whole, tariff situation, from the breakout to this high, that was 22 weeks. That was a place where you should think about hedging, where it would be normal to get a deeper correction. If you're 3 weeks out of the base, I mean, if it rolls over, you're totally wrong in the first place. So it's, if you're right about it being a leader, it needs more time. So time is an element I would consider if I was you. Most people don't think of it from that perspective. And one of my favorite tools is this here as well. You can add to your charts. It's called max distance from the weekly average. What I do is I look at the high of the week from the 10-week moving average. Most people will look at the close. I don't like the close because, like a stall week like this, it won't show it as very extended, because by the end of the week, the close is lower. I want to know at the largest extension, how far were we from the 10-week average? So if you take a look at, let's say like a Robinhood, each stock will get its own character. So this is the kind of stock that tends to find consolidation when you're at the 40% range. This is why we opted more for selling a little bit of stock instead of hedging, because it was also very extended at that point. So taking a look at how far you are from a 10-week average, but also understanding what the character is for that stock. Like, for example, a stock like JBL, probably won't get up to 40%. This will get extended. If you look here, a stock like this extended probably, what did I do here? Extended is probably 23, 22, 23% in bull market environments. If it's not a big bull market, it's lower. But if you think it's a leader, it's probably going to get to 23 or 22. And you'll see that from other times where it got to that area. So understanding the character of your stock, part of that is what the volatility of the stock is, what the growth trends are. They all ends up getting related, and each stock will have its own character typically. Vinny says, is your mentality more, my stops are in and what happens, happens. If it reverses and closes better, I'll buy back at the end of the day, or I will wait for the close to cut if needed. My stops are in typically because you really don't know where it ends. Like there's sometimes I'll call it audible. Like when people, even members will say, "Oh, Matt, is there ever a time where you don't use your stop?" Yeah, there's exceptions. You don't have to be a robot, but you want it to be like for a logical reasons, not just because I feel like it won't break down. Like one exception I'll give myself personally is, where's that chart I'm looking for here? If a stock is acting wild, let's say like Rubric here, it's having a really bad day. Like I think at the low of that day, real quick, it was down like 12%. No news, it was just a bad market day. That was at August 1st slam. So like the market's having a bad day, you're down 12% in one day, and it's also coinciding with our fear readings. So I mean, do I want to sell in panic down 12% in one day when we're seeing fear readings and we're at support? I mean, look, if it's a 75% position, I got to figure something out here. So something's going wrong. But if it's 10% position, and the rest of the portfolio is holding well, but there's also portfolio metrics you want to look at. You want to look at stocks, but you also don't want to look at them in a vacuum. Like the portfolio exists. I think that's also another problem that so many people have learning markets is everyone teaches from a stock perspective, but then you're learning it from a stock perspective. It's like almost, let's say you're learning sports. You learn baseball, but you only ever go to a batting cage. And then suddenly say, okay, you're in the major leagues, get out there and go play. But all you ever learned was a batting cage. You don't know what fielding is. You don't know what other runners are going to do, or same, or let's say it's football, or let me call it American football. Europeans will get mad at me. Same thing. All I ever do is just throw the football with my friend, and then suddenly, okay, now get on the field and play with a full lineup of players. So like you have to always kind of take consideration also the portfolio, the general market, and those are the rare times I'll call them audible. Deborah says, thanks so much for doing this AMA. Any advice for those who tend to close positions at the end of the day or within a few days, especially in a choppy market? My pleasure, Deborah. I think that's fine. Like I personally err on the side of I'd rather take a smaller loss and take more losses than a big loss. I think from your note, you're like me. We're in the minority. Most people don't like the feeling of losing. So I'm fine with taking a small loss, and even if it's 2%, 1%, you know what? I got enough exposure elsewhere. I'll try this again tomorrow if things improve. For now, I'll be out, and sometimes I'll trade that way. The only caveat to that is you can get carried away with that. So you have to kind of have some guardrails for how much you'll trade, because even a 1.5%, 2% loss can get out of hand if you have 30 or 40 of those. Then it's a problem. And in a really choppy, bad market, that can happen. So you have to have some guardrails around that, and so you can kind of slow your process. That's kind of where my concept of what's ideal portfolio exposure. If let's say it's 30 to 60%, it's mid, or 30 to 50% in mid range, and I'm at 45%, and my last 3 trades failed. Well, if I'm already at 45% and the market's choppy, maybe I back off a little bit to see if I can see some progress in the positions I'm holding. That's a little bit where kind of like the position management helps, also like the stock like pace of entering and turnover being under control. So that's something I kind of keep in mind. Rupesh says, I heavily shorted or bought the SQQQ on August 1st. Now I don't know where to sell. Now hope is a strategy. Yeah, that's a bad place to be. And you know what? I've been in those shoes. It's not a fun place to be. I can't give personal financial advice, unfortunately. So, but sometimes what I've learned in the past the hard way is sometimes even the hard loss is the right one, because then they can keep getting worse and worse. So, but I wish you the best of luck. I hope, in a way, I hope you don't make your money back, because that would hurt me. But at the same time, I hope you make your money back. So I'm rooting for you. I hope you make. I hope this trade doesn't go well for you, so we all survive. At the same time, you make even more money back on a new trade that comes around as a result elsewhere. What jokes aside, one thing I would say is, no one trade matters. There's going to be a lot of trades in your life and your career. If ever you feel like this is the trade that has to happen, you put yourself in a bad place. So just always kind of make sure you manage that top level risk to make sure you don't get yourself boxed in anywhere. James says, does one get your trading strategy with your premium or insider membership? Yeah. So all of this, this whole membership stuff here we're talking about, this is with both of them, with the premium and the insider. Insider has like extra perks. Like there's real-time alerts. There's the Discord for signups, for the video calls, which we have twice a week. There's live Q&A. You can come on, we can chat. So there's all these like extra added features. So I try and make it just reasonable. Some people want to pay a little bit less and they want lower touch. Some people want to chat and communicate more, and I charge more. So I'm just here to kind of provide what makes sense for everyone's, where they see value for themselves. But yeah, this all comes with both. SC says, Matt, could I ask your weekend routine besides the screening? Thanks. So besides the screening, so actually I'll show you one other element to this process here. So market reports. So on the weekend, even though we have a Sunday call, what I did was I kind of compile like a weekly report, which is basically like my process. It kicked off from being like my personal notes, which I put into a report for members. And if you follow on X, if you follow Caruso Insights, Sinea, my colleague Sinea always posts the where is it here? Where's the top tweet? Yeah, she always posts the kind of the introductory, like general thoughts. So, if you ever want to follow along each week, this comes out here as just like general thoughts, what we're looking at. So besides, so basically this is once I've done all my work, these are just my general thoughts. And to me, these are important because during the week, sometimes you can be busy with life. I don't know. I've got 3 kids and, a family and trading and just life. And you say, well, what was that big thing I was looking at again? These are my notes to kind of always keep me centered around what's going on. And part of that as well, apologies for the zooming here. Part of that is understanding like what are the upcoming macro events, how the portfolio changed, who are the current 3-month relative strength leaders. Then I always look at which stocks are in bases. And then importantly, there's a bunch of market charts that I always follow to keep me centered with the market. I'll look at net highs and net lows for the NASDAQ and the NYSE to look at general trend. I'll look at my FOMO indicator to see where that is. I'll look at those junk bonds I mentioned earlier in the call, what's going on with that. I'll look at the VIX. There's some relationships that I look at there for market tops and bottoms. I did in a workshop earlier in the year. I'll look at just different interest rates to see how our government rate's doing, and I'll look at commodities. And that usually altogether gives me a good understanding of what the market's doing, who the leading stocks are, what's basing, how my portfolio has changed, what are upcoming events, and just a written like note to myself at the top of what to expect in the coming weeks. So that's kind of what I do. Chris says, what are your thoughts on the degree of a pullback if and when it occurs? Lots of calls are that a minor 3 to 5% back to the 50-day this month. A longtime follower. Thank you for the awesome work. My pleasure, Chris. Look, it's one of those things. Like, of course, it's possible. Like, it would be very normal to go to a 50-day moving average, but at the same time, in really strong bull, that's the call I had with members. What are we Monday today? Yesterday, we were looking at all these strong bull markets, like 1995. We were looking at some others. I was saying just the irony of why it's so hard to hold on to a winner is everyone wants to find these great companies. And then the whole time the market's going up, everyone's worried that they're going to fall. It's this weird psychological thing us humans have, And so that's why, I was just kind of saying, if you go back to these other time periods, it's great to study them, because if you don't see that it's possible or that it's been done or that, markets under certain environments can do it, you won't think it's possible. So like 95 is that great example, because again, I think this is the template I had here. Was it here or was I looking at? One second. Like 1995 is where I'm kind of pivoting off of. Actually, here we have our recent example. This is 1995. It had that same pullback, and then it went up. And don't you think everyone in May of 1995 was saying, "Oh, this should pull back to the 50-day"? Well, guess what? You went vertical. So the market's going to do what the market's going to do. A big part this week is going to be what Powell does. Powell says. I kind of got to the point of how I interpret things, almost like a musician. I played guitar a lot growing up, and musicians who can read music, you don't have to memorize a song. You can just read the notes as they come along. And I think markets are like that in a big way. You're not going to know what's going to happen for every day. You don't know if the market's going to pull back, but I know how the market should react if Powell says something. I know how the market should react if rates do something. I should know how the market should react if the president does something or if stocks do something. So part of it is just interpreting the notes as they come along, because nobody can predict. If anyone was, imagine, you build your whole strategy around finding these great stocks, finding bull markets. Then it's 1995. You're in the middle of an internet revolution. And because you're up 6 days in a row, you go to cash ahead of an epic bull market just because you were expecting a 3% pullback. That there's risks to being invested. There's risks to not being invested. And all we can do is just balance it as the data comes across. Shane says, hey, Matt, you stick within the top 40 industry groups of IBD and then fish in the top sectors. Do you focus on the top 1, 2, 3 stocks? Great content. I'm loving the FOMO indicator. That FOMO indicator has got to be one of the best things I've come up with in a long time. I just love that thing. It's become so important to me. So I really don't scan with IBD's industry groups. I try and scan by stocks. Then I build my leaders list, like which I showed I have here, which I share it for TradingView. I also give a CSV file if people want to import it into Market Surge or TrendSpider or whatever else they use. And so once I have this list, again, you get to know this list over time. There's a difference between building a list the first time and then updating it week by week. When you're updating a list week by week, very few names are changing. So with time, you just naturally start to kind of, I investigate each stock. Like I don't know each stock perfectly. I don't know every element of each stock's balance sheet. But I understand each stock's theme. I understand each stock's industry, who its key competitors are. And so with time, you kind of start to gravitate. You understand who are the strong themes, where are the strong groups. Just naturally, if you do it properly, you should end up with a lot of stocks with the top groups. But I don't personally begin the process by group study. But that's a personal choice. Donald says, Matt, this is an amazing presentation. Thank you. Thank you very much, Donald. Appreciate that. If I understand you about buying a leader off the moving average, you buy on the way down and don't wait for strength. See that it's always, I get that question so often. For some reason, it tends to blow people's minds. I like to buy it on the way down. I think it's just the way, technical analysis is taught, and that you always want this confirmation. And it's true, but I think it may be a big part of having been a market maker where my whole business was fading moves in either direction. It's like, I'm fine if something's coming down normally. You want to kind of put that position on the way down, and then you can then sell it on the way up. And I'm mindful when I'm buying on the way down. I'm mindful of what the FOMO indicator is doing. Like if we are at FOMO, I don't want to buy pullbacks. Not yet. I don't want to do much of anything because the market's heated. We're probably going to get 3 or 4 days of pullback. If we start to get to the lower end of things, yeah, give me a little more weakness. Now, not only is this stock on support, the whole market is due for a little bit of a bounce. So you should very quickly, within 1 or 2 days, be into strength. If I wait for the stock to turn and then I get in after it's rallied 6-7%, well, then if it just pulls back that same 5-6% and chop, I'm stopped out. So that's kind of, it's a bit of a hybrid system I've developed where it's like stock with the market, but that's the way I like to do it. I buy it right on the averages, but I keep in mind the environment. Chris says, I've also followed your analysis for over 2 or 3 years. Back testing it, you've been correct. Sorry, I forget. I think you're talking about the FOMO indicator, but I'm not sure what part you're mentioning there. Sorry. I know you put a question before, but I've answered so many here, I forget where that follow-up is from. Francisco says, thank you for sharing, Matt. For the next leg up, are you planning to add to your previous winners or have some other stock ideas in mind for a first buy? It depends how they build out. Like I really think the character of TEM has changed. And, frustratingly, I just missed it. I saw us coming to the 50. I was traveling. We took a little family trip to New York City last weekend to go see a Yankees game. My sons have really gotten into baseball. So it was a lot of fun. And so I was driving back and I said, okay, I'll see how it closes. And it closed so strong. So I'll see tomorrow morning. And it just kind of took off without me and hasn't come back. So this is one that I think is turning, is becoming a potential new leader. Like I said, I've been building positions in RKT, which, you know, there can be chop. We see, this is a good example of, we bought this right on the 8 exponential, excuse me, the 8 exponential moving average. It's another variation of a short-term pattern I'll use under certain context after a gap. And thankfully we sold into strength. And so now, you know, we're still in the nicely in the profit, because we sold a little bit into strength, but we bought it on the average. If we would have bought it after strength, we'd be underwater now. But new ideas will come. It's really about like building that list of, it's building this list of leaders, and then always cycling through. Each week, I'm always looking for, what's the relative strength? Is someone being sold into? Who's being accumulated? What is the market doing? And it's just like constant. It seems overwhelming at first, but once you get into the process, it becomes like this nice, iterative, consistent process that you run that gives you a good sense of the market and the stocks at the same time, because they really are linked. And that's the way I do it. So if new names come up, we should find them, hopefully. James says, how do you value Bitcoin treasury companies? Those companies will start having crazy high EPS increases because of the FASB rule change, allowing the profits to be calculated based on the Bitcoin value. But would you even look at the market surge and say that is acceptable? Or do you call bogus on that kind of evaluation, since isn't through real revenue generated through normal corporate means? Or does it matter if the stocks go up? I agree. I mean, the way you phrased it, I think you find it doesn't make a lot of sense. I agree. Like, to me, it's basically the same as buying a closed-end fund that's trading above its NAV. You know, it doesn't make a whole lot of sense to me, especially maybe before, when people couldn't buy crypto directly, you know, with their regular brokerage accounts. They had to go off exchange. It was a whole kind of weird thing. Now that you can buy IBIT or Ethereum, why would I pay a premium to a company? Like, okay, fine, they're going to get EPS growth. I mean, does it work that way? Because you're not building, it's not basing off of recurring revenue. I mean, yeah, okay, maybe accounting wise, it's earnings per share, but you can't assign a multiple to it like a business, where you can expect, if you have a recurring revenue stream, that this multiple explains that this business will be able to do this for so many years. I call bogus on it personally. And that's why I've been focusing on the different companies, the different ETFs. Not that these companies in excitement can't double or do something wild. People can pay whatever they want for anything. But for me personally, it doesn't make a whole lot of sense to me from a financial perspective. If I put on my CFA hat, I don't see that as a great way to value the company personally. Cam says, do you use leaps as stock replacement strategy? I don't. There's a new strategy I've been kind of playing with. It's an options combination. We had a couple of calls with members where I kind of broke it down. Like, whenever I have ideas or kind of like slight changes to like the regular process, I like to run it in my own accounts for like months at least to get a good sense of how it all works. It's not quite leaps. It's like using options 6 months out. It's something I started talking about. I might have a workshop on it at some point, but it's not something I do with the membership currently. James says the Jackson Hole meeting is Friday. Would that prevent you from taking a good setup this week? Well, that's why, if you notice, all the setups are pullbacks. It's why I don't want to buy into strength. We were just talking about that today with members. Like, basically everybody going into Friday is considered a weak hand. Like who wants to put on a lot of exposure to like Thursday afternoon? I mean, you can, but you can also go to the casino and play red or black, you know? So if you're a HFT or an algo, isn't the easiest money in the world like running stocks up real quick to get people to buy them, or getting shorts to cover, then bring it back down to, you know, do the reverse. So for me, if things want to come down to my levels this week, fine. And you can see they're not terribly close to the current price action. So it would take a fair amount of weakness, but like kind of buying something on a breakout, or, you know, I think like Hinge went for a breakout today and like just totally stalled. Another reason why I just don't like breakouts in general. But yeah, this week I'm playing my cards a little closer to my chest this week, and waiting for things to kind of come to me. Vinny says, for years I've trusted my eyes but never actioned my alerts, only to watch things run. Now when my alerts trigger, I buy. Do you alert specific levels or save them for its go time? So okay, well, so with a membership, the alerts you get is when a trigger price would happen. What do I do personally? I have a bunch of different levels. I know mentally where go time is, but I want to know, you know, for me, it's important to see how a stock is acting during the day. Like, every time the market has an upswing intraday, how is the stock acting? If the market pulls back, what's the stock doing? So I'm usually in front of my screen all day, but if it's like now summertime and I'm spending some time with the kids or something and I'm off my desk, I still want to have that pulse. So stocks I'm watching closely, I'll have alerts like all around, and it'll help keep me in sync even if I'm off my desk. Angela says, hey, Matt, how do you know when the money is going to flow from one sector to another in the stock market? You don't always know. It's not so easy. It's one of those things that in retrospect is always nice and easy. Sometimes you can have a sense of it, like, like Fed rate cuts, if they start to happen and if he changes his kind of forecast, for sure, it's going to have an impact on interest rate sensitive stocks. But it's very difficult to tell in real time. You can't always be where every flow is, and unfortunately, sometimes they're so short term. Even if you do catch it, last 3 days and it goes back the other way. So it's never been something that's been one of my strengths, to be honest. Yogesh says, do you consider the number of stocks above the 50 and the 200 breadth indicators? I've looked at them, but what I really like about the 5-day is if you look at the percentage of stocks above the 5-day, that really represents impulse buying or selling. Like if 90% of stocks in the past 5 days are below their 5-day average, like people have been sold everything. It's just been outright selling. And over 5 days, emotions are very strong over 5 days. If you have a bad 3 or 4 trading days in a row, you feel that. Like the 50-day and the 200-day, not that there's no value in that. I'll look at those trends as well to get a sense of where broader positioning is. But I don't think it has the same emotional connection as like the FOMO indicator. So it's whereas a FOMO indicator is a key tool of mine, looking at the percentage above the 50 and 200 is more of a secondary tool. Okay, I think we have finally the last question here, and I got to get running anyways. Do you have criteria to buy a new idea instead of continuation buys on a stock you already have, considering both have buy signals the same day? Yes, I mean, I'll buy both if they're both available. Part of it, like I said, is, we look at ideal exposure. I always want to keep in mind also how many stocks will trigger in a day. If we have many stocks, sometimes we have many ideas, and I'll put in notes up here, only the first 2-3 stocks that trigger, the first 2 or the first 3 stocks that trigger will qualify for the portfolio, just to manage, because I don't want to necessarily put on 80% exposure in one day. That's too much in one day. So I'll limit that for the portfolio, for the exposure. And if, let's say, the all do trigger, I'll follow the ones that are not eligible for the portfolio. I'll follow them down here. Right now, we don't have any. In case somebody did buy the stock and they want me to follow up with it, I can kind of keep track of things that way. Yeah, so that's part of it is how much exposure I want to add to the portfolio that day. I mean, it says big episodic pivot guy, or you put your own spin on it. I'm not a big, I love the idea of it. And when they work fantastic. But there's also like a higher fail churn rate. Like the way I do it personally, there's always personal flavors. I know some are phenomenal at it. That's their bread and butter. That's never been my bread and butter. But if I'm already in a stock and I have a position and there's a big gap up and I think it's, a step change, it's a big important change, I'll use that to build into an existing position because I already understand the story. I already understand the idea. I already have a good core position to work off of. But I personally don't go around chasing just big gap ups every day, everywhere on all the different earnings reports and news announcements. It's never was my style of trading. Okay, great. Well, geez, we got a whole lot of talking here. Alexander said, what does AMA stand for? It stands for Ask Me Anything. So I feel like I answered quite a few questions. So I appreciate everyone for calling in today. There'll be the recording of this going out a little bit later. And I wish you all the best of luck. Again, markets are a great place. If you dedicate it and you work hard at it, I think there's a lot of opportunity. And it's a nice place where I think everybody can win together and we help each other learn a little bit. So I wish you all the best. And if ever I can be some help, I'm just an email away. Talk to you soon and see you probably in a few months at the next AMA or Ask Me Anything. Talk to you soon. Good night.